All right, folks. Well, let's get started here on this Sunday, Wednesday afternoon. It's beautiful here in the city. I might be a little bit long after the end of the year, but wishing everybody a happy new year. It will likely be the last time I'll say it this year. But I hope everybody had a great holidays and have had a good start to the new year. Happy we're able to jump on and join, that you're able to join this session. There's lots of things going on in the economy and the markets, and it's quite timely. So just a couple of housekeeping items. If you do want to put a question in, I will do my best to answer them either throughout the session or at the very end. At the bottom of your screen, if you're on a computer, there's a Q&A section or a Q&A button. If you are on an iPad, I believe you can swipe around and actually find that Q&A as well. So again, feel free to ask away. I will probably chat for about 30 minutes, give or take, maybe a little bit longer, depending on what kind of questions we get. But hopefully you find the information timely and informative. And without further delay, we'll get into it. All right. Sorry, guys. There we go. So the agenda. So we're going to go back, look at what happened in 2024, and then spend some time on just the 2025 market and economic outlook. Obviously, Trudeau resigning recently throws a little bit of a wrench in the Canadian economic policies and even the market. Talk a little bit about Trump, who will be taking office in the next couple of weeks. And then really focus a little bit on some of the headwinds, the key themes that we see happening here to start the years. And we will talk about some positives as well. We do believe 2025 to be a decent year, coming off kind of two stellar back-to-back years here in the markets. And then I'll follow up with some tax considerations to start the year, go through some of the tax rates, talk a little bit about RSPs and RIFs. I know we get a lot of questions about them, so I'll spend a few minutes talking about those as well. So I've always liked this. We've said this for years. You know, we can't direct the wind, but we can adjust our sails. And I think as investors, this is probably a pretty good mantra this year. Like I said, we're coming off two pretty solid years in the markets after the first bear market in 2022. The S&P 500 did something it hadn't done in almost 30 years, which is to post back-to-back 20% gains. TSX was obviously a little bit more muted. NASDAQ was a little bit better. But generally speaking, coming out of 2022, markets have actually been quite robust. Hasn't been a widespread or a good market breadth in terms of growth. It's really been driven by a handful of companies, and we still continue to see this today. And I will talk about this here briefly. You know, when Trump was elected, we actually saw some renewed optimism within the markets. The first week after he was elected, you know, if you look at that middle column here, you know, we had a fairly significant bump in the markets. But from that point on, from the second week of November there, most sectors on the S&P 500 have been very underwhelming. There's been a lot of uncertainty. December wasn't, you know, a stellar month. And I think it's really important as we chat about this, is we had a number of successful or wins throughout the year. You know, I think it's actually good to go back and look at perspective of what generally happens in the market. And I will touch on this with a couple slides. But, you know, since Trump has been elected, it's been fairly muted for the last 6 weeks of the year. So let's switch. The key theme of 2022, 2023, and 2024 was this, you know, sticky inflation and interest rate market. And so what this actually illustrates here, I've been talking about it for the last 12 to 18 months. Here's where we stand today. This doesn't include the US data that came out this morning. I'll talk about that here briefly. But in general, we can see inflation both in the US and Canada have actually trended down from its peaks, you know, back almost 18 months ago. And with that, you know, and it always lags, but we're starting to see interest rates. Central banks are also starting to cut as well. Canada, Bank of Canada has been much more aggressive at cutting rates than obviously the US has. We'll talk a little bit about the US Fed and what we think is going to happen. With respect to inflation numbers in general, what's, you know, a little bit problematic despite the positive numbers that came out this morning in the US is we can actually see that inflation is ticking up a little bit. And this is a little bit problematic for central banks, and especially in the US. And again, with some of the Trump policies, which I mentioned that we'll chat about it. But any kind of sticky inflation or it being reignited is problematic for markets and also the economy. So listen, even though inflation's coming down, I came across this photo and it's really true. The economic data with the inflation numbers is improving. But again, if you go out to the grocery store and anybody here that has bought groceries here in the last two months, 3-4 months, especially with Christmas, and we're cooking for our families and so on, our dollar doesn't go as far. And again, this is just over 15 years, but you're walking out and spending a couple $100 for only a few bags. And what I actually found funny about this one, I realized this afterwards, but it's probably not necessarily a bad thing for inflation for this gentleman. If you look at the left, he has a lot of unhealthy foods. He has these chips and Nesquik and Nutty Buddies, and with inflation, he's eating much healthier now, which I guess is the one benefit of it. But all things considered, again, our dollar doesn't stretch as far, which again goes back to why we have to invest. So let's look at this. So falling rates mean falling yields. I've been talking about this for the last 6 to 9 months. What's problematic with what we're going through right now is, we enjoyed the benefit of high rates, in 2023, 2024, when rates were, near all-time highs, or not all-time highs, but recent highs that we hadn't seen in probably 3 decades. And as a benefit, we could actually buy, very low risk-free assets in GICs and high interest savings accounts and get over 5%. But now what's happening as our rates are coming down with central banks, yields are also falling as well. So 1-year GICs today maybe are right around 3%, 3.2%. High interest savings accounts are around 3% as well. We anticipate this to continue to fall throughout 2025 as central banks continue to cut their rates. And when we actually look at, interest-bearing vehicles, and I bring this up, there's a lot of folks that are sitting on cash. They're sitting on cash in savings accounts or GICs or what have you. And what's really interesting about this chart, if you go back, the red lines, these red dashes, these are the income that you need to earn on a GIC to outpace inflation. That's what these bars are, okay? So if we take, let's say 2014, okay, the income needed to beat inflation, core inflation, was here. And this was the GIC income. This was the interest rates that you'd be earning on $100,000 of investable assets into a GIC. So there was a gap. So folks could actually buy something really conservative back in 2014, and their money went down. The purchasing power went down. Well, if you go back in the 80s and 90s when interest rates were really high, you could generate enough revenue off a GIC to outpace inflation. You can see these bars, these income were all higher than the inflation numbers. But starting just after the great financial crisis, or actually just before the financial crisis and then thereafter, we can see that GICs, they didn't keep up with inflation, which means over the last roughly 20 to 30 years, we've actually been earning less on short-term cash than what inflation is. And this most recent year, 2020, I guess it was 2023, 2024, it was the first time in 16 years that your interest income outpaced inflation. And we can see that there. Okay, so this is a rarity. And what we're going to see is we're going to actually start seeing this year, next year, the following year, in all likelihood, this interest-bearing investments that are generated from GICs or high interest savings accounts will actually be lower than the inflation rate, which means your money is no longer growing on your behalf. Okay, so what has history taught us when rates go down? So this is a great chart. If we look at the baby blue line on the bottom, this is the interest rates, the overnight target interest rates. And we can see we came out of all-time lows, around between 1 to 2% for almost a decade, and then it dropped below 1% for just in 2020 coming out of COVID. And then we had this significant increase here in interest rates. Well, what the deposits in GICs, what was interesting is they stayed fairly consistent for almost a decade. And then as interest rates went up, you could actually see that GIC balances actually started to increase. And then as interest rates fell, same thing with the GIC balances. And then with the sharp uptick here in the last couple of years, we've actually seen GIC balances go up significantly. Well, what we anticipate will happen as interest rates continue to fall, the GIC balances will catch up, and we're going to start to see less and less Canadians investing in GICs, which means we have no choice but to be looking for other ways to invest our money to keep up with tax and inflation. Okay. So when we look at unemployment numbers, again, going back, this is the Canadian unemployment number. It has actually increased. This is actually a good thing. The reason why it's good is for the central bank, the Bank of Canada, they look at a couple things when they look at interest rate policy or monetary policy. Number one, they look at the inflation rate. Is it trending down, which we've seen it has? And then the second thing they look at is our employment numbers doing well? Is it going up or down? Well, generally, when you have a strong labor market, it actually creates a little bit of headwinds for the central banks to actually continue to cut. So when there's a lot of job growth, that means a lot of folks are making money. There's more money in the economy, drives prices up. So the fact that we're seeing unemployment in Canada is actually a good thing for central banks. Our rates are coming down, or the inflation rates are coming down. Employment is weakening. Therefore, we believe their game plan will be to continue to cut, maybe not as at an aggressive pace for the year, but we do believe they'll continue to cut. Now, in the US, it's the opposite. Their labor numbers are actually pretty strong. So jobless claims have risen, but their most recent data is actually coming higher than what has been anticipated. And therefore, the US Fed, the likelihood of them cutting is lower. We had good inflation data this morning. We had good CPI data this morning out of the US, which is the reason the markets are gathering or recapturing some of their declines over the last week or so. But the markets are looking for negative news to motivate the US Fed to cut. Their labor situation does not give us a lot of confidence. And a lot of analysts actually think that they may not cut till mid-year this year. And we might only see maybe 2 to 3 rate cuts this year, which is much slower. They're lagging Canada, the Bank of Canada, in terms of the pace of their cuts. So again, if they do cut, it's good for our dollar. It's good for the economy. It's good for lending and so on and so forth. But again, the US Fed, it's a very slippery slope for them just based on what today's data is. All right, so I'm going to talk about key themes here in 2025. I'm just looking here, just one sec. I just have a couple questions. Actually, it was a comment. They were just talking about interest rates and whether they were sustainable, and I don't believe they are. High interest rates, like I said, the economy will be in a better place with lower interest rates, and central banks, like I said, I believe that's where they want to go, especially, Europe's cutting, Canada's cutting, US is just slow to the party. So all right, so key things. So, with the stock market, there are some headwinds. We've come off, 2 back-to-back really good years, but we don't anticipate it to be as rosy this year. We think that there will be gains in the market throughout the year, but there's going to be some headwinds to get there. Trade wars, fiscal policy, slow growth, and I've already hit on a couple of those right now. So a couple of things. So true to resignation. All right, this is a big one. So is it good? Is it bad? I'm not going to get into politics or what I believe. I'm just going to talk to you about how it might or how it could impact the markets and our economy, and then also what the benefit is with having new leadership. So first one is uncertainty. Most articles I'm reading right now, it all talks about uncertainty within not only Canadian markets, but also global markets, including the US. So there is this short-term uncertainty for the Canadian economy and markets. There's delays to business decisions that will likely mean businesses and foreign investors will be cautious. It's problematic because it kind of puts us in a holding pattern. We don't really know what direction that obviously from a political point of view, we're going to be going. Couple that with Trump coming in with his policies. We don't have, our full team here in Canada, on board to really fight whatever he's going to potentially bring in. That being said, the fact that he's stepping down and resigning sooner rather than later, it could help Canada be more open for business, more pro-business with different leadership. We could see a benefit to energy. Right now, energy over the last 2 to 3 years has actually done fairly well despite our lack of pro-business policies, to be honest. But we believe with new leadership that there are going to be some sectors that will do better, including energy. Infrastructure is another one, capital spending. So these companies will benefit from it. Like I said, is if you ask most people, regardless of whether you like them or not, I think the one thing most people agree with is that Canada's economy has been very sluggish for the last few years. And so I think with new leadership, we actually could get kind of like what happened in the US. We get this optimistic outlook. We get this, initial bump in just kind of this renewed optimism about what we think the economy and markets could look like. And then it will likely, the honeymoon will probably be over. And then, they have to, put the, rubber to the road to make sure that they're implementing and making good on their promises. And then the last one is the Canadian dollar could stabilize and start to appreciate with new leadership. And that will be helpful because right now I think it's we're at a low. I think it's a 5-year low, but it hasn't been great, the US dollar. So anybody or Canadian dollar against the US, anybody that's traveling right now, obviously we're paying a little bit more to get out and find that sunshine. Now on the US side, Trump, lots of broken promises, lots of unknowns. He is definitely a wild card, is probably the understatement of the year. And because of that, it creates a new wave of uncertainty for global economies and markets. It's not just Canada. His policies could increase market volatility here in the near term, slow GDP growth. What's really big, what's problematic is everybody's talking about these tariffs, this flat tariff, 25% or what have you. It's not great for Canada or the US. It's not just, problematic for us. One of the challenges, if he imposes these tariffs, at the end of the day, these businesses and companies, they're not going to absorb that additional cost. They're going to pass that down to the end user, which is you and me, or the other folks that are in the US. And what happens if goods and services goes up is inflation could actually go back up, which again, what's problematic is now the US Fed might slow how quick they're going to be cutting interest rates, which we all recognize is something that the economies both here in Canada and the US could benefit from. Now, with respect to the tariffs, some of you have heard me say this. I don't know if he will put a flat 25% in. I think he's trying to get people to the negotiating table. I think he's trying to through the fear of tariffs, he's trying to get a good position to negotiate for the US. US, Canada, Mexico trade agreement is coming up next year. And so what it's done, it's actually forced countries to come to the table. And you look, he's a little wild. He's talked about he wants to take over Greenland. He wants to take over the Panama Canal. So I heard somebody the other day that said he wanted to rename the Gulf of Mexico the Gulf of America. So he's out there with a lot of different comments, which I don't know, as a Canadian, it makes me feel a little bit more comfortable knowing that he's just all over the place. But that being said, in his first term, he did impose tariffs on lumber, Canadian steel, Canadian aluminum, and in response, Canada ended up slapping tariffs on US goods. So it's not good for anybody. If it does happen, I don't know if it's going to be long term. I'm sure we'll have some tariffs, but hopefully it won't have as significant of an impact as what we anticipate. Now, despite all this, he's inheriting an economy that's actually doing quite well. And he has pro-business policies, deregulation, tax cuts, and so on. So this should be favorable for U.S. markets mid to long term, despite some of these headwinds that we might see here in the near term. And just a couple of slides, just to, when I talk about rate cuts, with Trump, based on the tariffs and tax cuts, that he's talking about, 60% of the folks through a Bloomberg survey felt that there was going to be fewer rate cuts by the U.S. Fed, and that's exactly what we're talking about here today, which again could create some volatility in the markets. Okay, and then what's the impact to Canada? With tariffs, Canadian GDP slows, same thing, which isn't great for the economy. This is just showing base case scenario what our GDP growth could look like. If there's 10% tariffs, 25% tariffs, and then if there's 25% tariffs on both sides, you could actually see that a trade war, it's not great for the either economy, both here in Canada and the US. So we'll do our best to navigate it, guys. Like I said, companies will still continue to grow despite things being a little more sluggish. We, as I said before, we can adjust the sails. We can't control what's going to happen, politically, economically, and so on, but we can actually rotate, be proactive, and position, our families and clients the best we can to take advantage of whatever happens. All right, so beyond political, here's some other headwinds. So one of the things, I've been talking about for a while, but is this concentration risk. Again, this is just right up to the end of 2024. If you look at the top 10 stocks on the S&P 500, roughly 37% of the market is held within those top 10 stocks. When you go back historically, you go back 20 years, it was below 30%. And even most recently, just 4 years ago, it was, just over 30%. So concentration risk has increased. Of those top 10 holdings, the top 7, which are your mega 7, your Metas, your Googles, Amazons, and so on, they represent close to 28% of that top 10% holding. So the reason we bring it up is as we face some headwinds of some of these that are richly valued, take a breather, we're going to see the markets in general be impacted by that. So it's important that not only are we participating with some of these good, strong companies, but we're also diversifying, our clients' approach to make sure that if, one side doesn't do as well, we have other investments that will pick up their sluggish pace. And then the last one that I have here, I think this is the last one, is the valuation risks. So U.S. stocks have rarely been pricier, okay? And part of this is because this whole AI intelligence, it's just supercharged the performance of the biggest stocks. So I mentioned it before, Amazon, Apple, Meta, and so on. They have had such big growth, their valuations are just out of whack right now, okay? And relative to the rest of the world, it's the highest it's been in almost 4 decades. Now, that being said, I don't think it's as problematic as, the tech bubble that we saw in 2000. These companies, these large companies, they have, war chests of cash. They pay dividends. They're not fly-by-night type companies. These are going to be around long term. You look at a company like Microsoft, they're just not all AI focused. They have different silos of businesses that do well for them. So for whatever reason, things in one area of their business doesn't do well, they do have other strategic partnerships and silos that will offset potentially some of the risks. But that being said, we can't dismiss the valuations of companies right now. And despite all those risks, and I said this before, our money needs to be working for us. And it goes back to that slide that I mentioned earlier versus GIC income and inflation rates. Folks, we have to outpace it. That's the whole reason people invest. Some people on this call might invest because it's fun, perhaps. But the most reason why people invest is because they need to keep up with tax and inflation. They need to have their money grow to offset, lifestyle expenses. And the only way to do that is to buy a combination of different assets, whether it's stocks, real estate, alternative investments, or what have you. You need a mixture that actually continues to grow beyond that inflation number. So let's look at this a little bit. So again, going back to perspective and recency bias, even the best years, they feature some volatility. The reason I bring up volatility, folks, isn't to be negative, but rather I've had a few comments where people get their December statements or November, and they're saying, hey, I noticed that we're down a little bit. Well, absolutely. We've just become so accustomed of having gains every month in the markets, we forget that markets go up and down, and there are periods of volatility. So here's a good example: the 10 best years on the S&P, the TSX, and every one of these years that have been the strongest, you can see here they've had drawdowns. And it's not unique to the 10 best years. Every year we generally see some sort of period where we see drawdowns. It's just we haven't seen it a lot in the last 12 to 18 months. So if we do see this, I just want to prepare you. Don't be concerned. Like I said, this is natural. If we go back to bull markets, we go through sustained years or periods of time where we see upward trends, even though there's these dips, okay? And then we're followed by periods of contraction. And then we have these sustained periods of upwards, and then vice versa, okay? So we are likely in the 3rd year of this bull market. 2022 was the first bear market we had experienced. And then from here now we have, 2023, 2024. We anticipate to have positive years going forward. But again, we will have some headwinds. So just be prepared for it. We're prepared for it. We anticipate it. if we go back to 2022 for a lot of our clients, if we look at our statements, markets were down between 10 to 35%. Most of our clients were down 5 to 10%, depending on what type of risk they had. So we do try and plan for the volatility rather than just reacting when it occurs. Okay. So here's the good. Okay. And I've talked about this before. There are different cycles throughout history. And if we go, first wave, second wave, third wave, and so on, it's just how the economy and how we evolve over time. And if we actually look where we are today, here's this kind of sixth wave. We kind of came out of the fifth wave, probably at the tail end. Digital network software, new media sources, and so on, internet. Well, now we're moving into AI, robotics, clean technology, and so on. So this is in its infancy. This is what's driving these big 7 companies, this whole AI and automation, and we're seeing this significantly. But it's not the first time we've seen it. We've actually seen it over time, and they tend to last, for years on end. They are getting shorter because technology moves quicker. But again, we could see the next 15 to 20 years of this next wave that we're seeing. And again, companies and investors are going to benefit from that. So we still anticipate good earnings from these companies. The problem is they might become their own worst enemy. And what I mean by that, and we saw this with Apple in their heyday. Apple would come out, all the analysts thought they would grow, let's say, by $57 billion for a quarter. Think about that. $57 billion in sales, but they came in at $54 billion and their stock, went down because they didn't get that last $3 billion. Okay, so these companies were impacted. They were hurt by missing their targets. It doesn't mean they weren't making money. It just they weren't making money as quickly. So with these big companies, that will likely happen. They're at some point gonna, give guidance to their future. They're gonna say things might slow down, but they will still make money, but just not at the same pace. Okay. So again, let's be mindful of that. If we do go through some volatility, here's the reason why. But again, all good markets go through those periods of time to get to new highs in the future. All right, so let's actually just we talked about equities a lot. Let's talk about non-equities and what's been happening. So just beyond traditional thinking, you've heard us talk about private investments, alternative investments. So we continue to see private investing, whether it's through private equity, venture capital, private credit, real estate infrastructure. It continues to grow. And we anticipate it to continue to grow here in the foreseeable future. All right, so why private real estate? Strong income, potential for capital growth, low correlation to publicly traded securities, which is what a lot of investors are looking for, and generally speaking, lower volatility. Okay. Now, when we look at traditional public real estate, we look at REITs. So as an example, for those of you that know the Lower Mainland, out in Langley, there is a company called RioCan. RioCan is a Canadian company that owns different properties across the country. One of the ones they own is in Langley on the bypass. There's a cactus club, a golf town, and so on. Well, that is a company that has several properties across the country, but it trades on the open market. And when it trades on the open market, it can be volatile. So when you look at publicly traded REITs, this is just an index, kind of like RioCans. But in the last 3 years, despite them paying strong income, this is what the net return would have been, anywhere of a loss between 10 to 16%. And so for a lot of investment professionals that are dealing with their clients, this is how they get them real estate exposure. Okay. Well, we've actually flipped it on the head a little bit, and we actually look at private real estate. For a lot of you on this call, you have Forsyth. Forsyth again is a fully sub-advised strategy. It has roughly, I think, between 15 to 20 sub-advisors currently in all different spaces, mostly income generating, whether it's multifamily, student housing, or so on. But over that same 3-year period versus public REITs, the private Forsyth real estate portfolio has done 25%. So that's a difference of close to 35 to 40% versus traditional real estate. Okay. This is one of the reasons we've been able to reduce risk for clients and get consistent, predictable returns. Okay. This is one asset class. Another one is private credit. So Rockridge Private Credit as an example. Why private credit? Enhanced diversification, lower volatility, and strong income and return potential. So again, most Canadians, especially retirees, they're out there chasing a bond or low risk investments. So when you go back, GICs, that filled that void for a lot of Canadians for the last 18 months. Well, now they're going to be in the same problematic situation where now they're going to go buy bonds. And in the last 3 years, this is what bond indexes have done. Okay, Canadian bond index, US bond index, total return has been negative 2 to 5%. All right, this is the problem when most Canadians are somewhere between 60 to 40% in this type of investment. Okay, well, Rockridge Private Credit, same thing over the last 3 years has averaged just under 20% over 3 years, just under about a 6.5% rate of return. So again, fantastic, really pleased with it. But again, gives you access to non-correlated investments that are producing income, whereas a lot of your friends or family that don't have access to this, they are accessing it through publicly traded bonds. And generally speaking, most Canadians own less than 1 to 2% of these types of investments. Meanwhile, the CPP has roughly 60 to 65%. The Ontario Teacher Plan is probably 50 to 60%. Most major pension plans, even endowment funds in the States, are well over 50, 60, 70% in these types of investments. So, all right, I'm switching gears here. Tax tips to start the year. I mentioned I would chat about it. So a couple of things where you actually get a benefit for making a contribution. So anybody here that's continuing that works, that has an employer plan, please make sure to make a contribution to the employer RRSP if they are matching. If they are not matching, then I would suggest to make it to your own RRSP because you have more investment choices. Okay, number one. Number two, for those of you that are that don't own a home or you have kids that you're trying to save or you're going to help, take advantage of the home buyer tax, the first time home buyer account. What that is you get similar growth to a TFSA, all tax free, but like an RSP, any contribution you put in there, you get a tax deduction, which is fantastic. It's kind of a hybrid between an RSP and a TFSA. Okay. For those of you that are self-employed, you can look at turning health expenses into tax deductions through a private health service plan. A lot of people confuse this with a benefit plan. That is not what it is. It is a platform that you sign up with a company. It usually costs about $200 one-time cost, and then you submit your receipts, usually for $25 to $50 every time you submit it. But you can turn these personal health expenses, dental expenses into corporate tax deductions. Okay. Number four, again, if you're incorporated, you can look at trying to tax shelter some of those assets in there. The government has come out with the new policy on capital gains. We talked about this mid-year. Now within a corporation, every dollar that is a capital gain, 2/3 of it is taxed, 1/3 of it is tax-free. Under the old rules, it was 50-50. So if you're incorporated, there are ways for you to tax shelter some of those assets and get it out of the corporation tax-free over time. Okay. Number five, contribute to an RDSP, a registered disability plan. If you happen to have kids or loved ones that qualify for it, maybe you're claiming the disability tax credit, they could be eligible for an RDSP. Once again, CRA makes it very attractive. For every dollar you put in, depending on the income, they sometimes match, or if not match, more than dollar for dollar. And then the last one, kids and grandkids, RESPs. Again, for every dollar you put in, they put in 25%. So again, you can put in up to $2,000, get a $500 grant paid in if they qualify for it. If you've missed years in the past, you can actually benefit by overfunding it. Okay. And again, sorry, it's 20% is what the actual grant is. So on 2,500, you get 500. So my apologies. But yeah, like I said, if you haven't done that yet, again, it's free money from the government. They're in the habit of taking our money. Use some of these programs where they give you some money. Okay. Be tax aware. I have like 4 slides left, folks, and then I'll open it up for some questions. So be tax aware. Obviously, interest income eligible, dividends and capital gains, all taxed differently. I'm showing this based on under $250,000 personal. If you had investment income of $10,000, interest income, you're only going to keep at 53.5% as an example, $4,650. A capital gain, you're going to keep, almost 50% more of that, $7,325. So when we're talking about cash flow, using investments that create eligible dividends or capital gains are more preferred than just interest income. So again, this goes back to as interest rates are falling, GIC participation is going down. Eligible dividend type securities or a windfall, you can still get some really good quality names paying anywhere between 4.5% to 6% right now. All right. Here's one that I wanted to spend a little bit of time. I get a lot of questions on this, folks. So I actually put a slide in here specifically. Some of you on this call already have a RIF or a LIF. But for a lot of you, you may have a spouse or maybe somebody else that has an RSP, and they're starting to think about having to convert it to a RIF or a LIF. Okay, so what a LIF is for everybody, and if they don't know, if you happen to have a registered account that was funded via a group plan, like a pension plan, that generally goes into what's called a LIRA, L-I-R-A. When you convert that at age 71, it goes into what's called a LIF. It just has some different guidelines. But for the purpose of this slide, I'm just going to talk about the RSP. Okay. So an RSP, everybody up to the age of 71 can have one. You can contribute money to it. You get a tax deduction, and all the money inside of it grows tax deferred. Okay. Now, at any point up to age 71, you can convert that. You can convert that to a RIF. Okay. There's no age limit to convert it, but at age 71, you have to convert it to an RS or to a RIF. And what that means is when the year that you turn 71, you have to open up a RIF account, okay, a separate account. And by the end of age 71, your RSP just has to roll into the RIF, okay? It's a non-taxable rollover, and all of the investments that are qualified in the RSP can all roll over to the RIF the exact same. Okay, so anything you can invest in an RSP, you can invest in a RIF. All right. Now, you get the same tax-deferred growth. The only two differences are actually the one of these are the same. Any withdrawal is taxable, so same as an RSP. But what is different is you have to take out what they call a RIF minimum amount, okay? And that RIF minimum amount is based on your age. So let me give you an example. I think I have this here. So here we go. So the RIF minimum payment at age 72, okay, the year that you're 72, you have to take out 5.4% of the value of your account. So if you have $100,000 in a RIF, the very first year at 72, you'd have to take out $5,400. That's it. Everything else can continue to be deferred and grow. Okay. If you have $1 million RIF, you have to take out $54,000. Right. Now, the only difference between a RIF and a LIF, remember I talked about the LIF having a little bit different rules. The LIF has a minimum and a maximum that you can take out. A RIF has a minimum, but it has no maximum. You could take out the full amount in 1 year and pay the tax all on it. Okay. So just good to know. And then on a LIF, again, I talk about it, the LIF percentages are the same. But again, there's a minimum and a maximum. And I won't get into them all. But again, the mechanism is exactly the same. You can take out the income on a monthly basis, which a lot of our clients do because they set it up to offset their lifestyle expenses. And it's like a check. It's like you're getting paid. Okay. Or you can take it on a quarterly or as a lump sum. For some of you that don't need it, you have pensions or what have you, what a lot of our clients will do is they will roll over their RIF amount, their RIF minimum amount into a non-registered account and perhaps make a TFSA contribution or what have you. Okay. Okay, last slide, key dates, folks. So tax season is around the corner. I've already started to get questions about it. So first thing, RSP deadline, March 3rd. Okay, maximum limit is $31,560. For those of you that want to make an RSP contribution, if you have the cash, make it sooner than later and get the money working for you. Number one. Number two, TFSA amount, $7,000. We are starting to work through this. Again, this is really the second week that we've been back in the office. So we are reviewing all accounts right now, and we will get these done. But we do want to confirm with you first that you have the available room, because from time to time we do have folks that'll be at a bank and they'll just suggest making one, and they won't. Unfortunately, our investors might not realize, but they'll over contribute, make a contribution there and here. We'll just want to make sure that you have the room for it. Spousal loan interest payments. So anybody that has a spousal loan, those are to be made by January 30th. That's the same for every year. Tax documents. This is a big one. People are asking. This will start likely at the end of the month. January 30th, and then you will continue to receive them between January 30th all the way up to April. Okay, but you shouldn't expect them for another couple weeks. Trading summaries T5008, that'll be coming out in February, roughly February 28th. And then T-slips, they will start in February, end of February, but they'll come up all the way up to the end of March. And folks, that's not something that's put in place by Harbourfront. And I still don't know, I scratch my head at this. CRA requires that institutions send them out by the end of March, which I think is a terrible time. And the reason I say that is often they are mailed. So if companies are sending them out, you're not getting them until maybe the first or second week of April. So CRA, if they could actually make it easier, maybe move that ahead, that would be fantastic. But they don't do anything easy for us. So they actually make the deadline as of March 31st. So you will get T-slips between now all the way up to the end of March. But you should be able to access some of these electronically earlier. So if you do have questions, reach out to us in February, March as they start to come out. Okay. And that's the last piece. And I have a couple questions that I'll go through, folks. If you do have some questions, type them in now. Now is the time. Other than that, I appreciate you guys spending your Wednesday afternoon with me. If you do have some specific questions that I don't cover off, please feel free to email me or the team, and we will get back to you. In the meantime, I'm going to look at these questions. Somebody was asking, do grandchildren need to be Canadian residents to get, I'm guessing, to get the RESP? They generally do, yes. They would not qualify for RESPs if they were a non-resident. Let's see. I have somebody here, and it just is a good question. They're just asking about various tax policies. Will they get passed, in time, whether it's in Canada or the US? It's a great question. I can talk about Canada specifically. Obviously, we had the new capital gain rule that came out in mid-year last year. They were changing the inclusion rate from 50-50 to 2/3, 1/3 for corporations. And then the same personally if you make over $250,000 in capital gains in any given year. With Trudeau resigning, we weren't quite sure what was going to happen with that because it technically hasn't been approved. It was just basically put into the budget with the expectation to be approved. Everything that we're reading right now is that despite Trudeau resigning and it not getting voted and implemented, the CRA is deeming it to already be in place. So I would anticipate any acts, any changes to likely go through, despite what's happening with our government. And even in the US, a little bit different, a little bit harder to get it through, but if they really want to push it through, I don't see them not getting it put in place. But that's probably a better question for maybe the US accountant on the US side. But for all intents and purposes here in Canada, those budget concerns or their budget proposals, CRA is looking at them as already being in place, unfortunately. So there are some other issues with that capital gain changes. And I mentioned it before, there's still a real lack of clarity. One of the things that we've asked is if you trigger capital gains pre-deadline at 50-50, but you do capital losses after the deadline, that's 2/3, 1/3, how does that get reflected? And we still haven't received any clarification from accountants or anybody else, and accountants haven't received clarification either. So I think it'll be fairly fluid between now and when we file taxes and over the next couple months. But like I said, the government they fumbled actually 2 to 3 different tax policies in the last 3 to 4 years. And I actually thought with Trudeau resigning, I thought it was a perfect opportunity for them to delay it for a year. But it doesn't look like they're going to, unfortunately. But who knows? With the trust filing that they were supposed to do this past year, they kiboshed it within a couple of days of the actual filing date. So never say never. We could see maybe something with the capital gains change. We'll see. What else here? I have some other questions here. Let me just scroll through them. Bear with me. What are my thoughts on super frothy, bubbly environment in U.S. markets, companies in quantum computing, high valuations, etc.? Yeah, so I mentioned it earlier. So frothy, bubbly environment in the U.S. markets, I mean, it is. I think you need to navigate it cautiously. There is some uncertainty in there. I would anticipate some choppiness. We just haven't seen it a ton. And we can see it, with out of the US, we can see companies that report good, strong earnings. They get a really big uptick in their share price immediately. And other ones that are swinging and missing, we're seeing them getting punished, 10-15% drawdowns in a trading session, which is significant. Okay, you have some of these companies that are losing market share as much as what some lose in a year in one day. So I think, again, you need to make sure that you're diversified. You got to make sure that you're owning the right types of companies. In terms of companies like quantum computing, there was an announcement not an announcement, there were some comments last week made in the sector that some of these quantum companies were years and years and years away from actually being profitable and actually making a dent within kind of this whole tech industry. And a lot of them fell 30, 40, 50% in a day. So, again, back to diversification, it's okay to own them, but let's own them in the right amount and the right percentages so that if, you swing and miss, it doesn't derail your retirement or your cash flow or the portfolio. And if you hit out of the park, obviously it improves the returns. So question here about what about investing in gold? Yeah, we don't mind it. We think gold isn't too bad. It's had a great year last year. Generally, it's an inflation hedge. What we're seeing with digital currency, nobody's asked me about that right now, but digital currency, a lot of folks are using that as a hedge to inflation. Challenge right now is it's super volatile. We're seeing big swings, 10, 15, 20%. Again, another one that actually had a great year last year. Bitcoin was hit all-time highs. But again, analysts are coming out. The head of JP Morgan came out and still said, Bitcoin doesn't really have a place. He doesn't understand how, you can buy and speculate, but I disagree a little bit. I think there is a place for it, but again, it's not a core holding because it's just so uncertain. And again, can be quite volatile. So it's likely an add-on rather than just a core piece. Whereas gold is the same thing. I mean, again, you don't get paid to own it. There's no dividends. But again, it's a good hedge, and gold did quite well last year. So just like anything else, you want to own it in the right amount. So missed the first part of the presentation. Yes, there will be a recording, will likely come out later this week or early next week. Just has to go through the proper channels. And then I actually have the last one here. So this is a great question, actually. A debt to income ratio across Canadians is really high and almost unpayable. Historically, Canadians were savers. How is this sustainable? Yeah, that is a great question. Listen, I just read an article within the last couple of days that stated that Canadians are as little as $200 away from not being able to pay their bills. Okay, so it is a problem. It's problematic. I think one of the big things that will be helpful is if interest rates, they continue to come down, interest rate policy, monetary policy. I think this is really important. We have to get, our debt payments a little bit more under control. And for a lot of Canadians, that have racked up some debt, they're actually paying really high numbers right now. So any relief that we get from the Bank of Canada will be beneficial. And slowly, we saw this coming out of COVID and some other markets, where debt was extremely high, even in the US, and we've seen a change where high debt has actually turned into more of a from savings, and we've actually seen especially in the US, their saving levels have increased. So it will happen here in Canada as well, but we just need to be a little bit more diligent, and I do think it'll be sustainable. But the Bank of Canada changes in monetary policy will really help, I think, to a certain extent. But it is problematic. It's one of the hot buttons here in Canada and the US. They have to get the debt under control. So we'll see what happens. So okay, that's the last of the questions, guys. I appreciate. Actually, I have one other question. Sorry, one other one. Just talked about innovation wave. How do we project the industry on clean tech to do, considering possible headwinds? Yeah, clean tech. What we're actually seeing even here in Canada. If we get a different leadership. ESG has been a real hot topic in terms of investing and I think political kind of policies. But if we get a change in leadership here in Canada, I think clean tech is still something that's top of mind. But I believe we're going to see energy, and not just clean tech energy. I think energy in general, oil, we've actually seen pop up. I think that'll change a little bit. And I believe that in the US too. They'll still do well, but clean tech in certain environments is a little bit newer. We've seen that even with alternative energy sources outside of traditional, where it takes a little bit longer for them to do well with companies in general. So, so we'll see. Like I said, Trump's policies are all over the place. We'll get a better idea here in the next few weeks. But again, tech in general has done quite well. So I would think over the next decade or so, maybe it's, clean tech will do really well. But in general, I think again there'll be some ups and downs. So, and then one last question. Sorry, you guys keep typing them in. They're good. USD versus CAD or CAD versus USD. If Canada continues to lower interest rates faster than the US, is it likely CAD will fall? It's possible. With the US inflation number that came out this morning, CAD improved. And when Trudeau stepped up and said he was going to resign, CAD also strengthened. So the bigger the divergence we get between US and Canadian interest rates, obviously the bigger pressure we have on Canadian dollar. But with a change in leadership, which I think is going to happen here in Canada, I think our US or Canadian dollar to the US will strengthen here in the mid to long term. And when I say long term, I don't mean 5-10 years, but probably in the next 6 to 12 months when we get some clarity on what's happening here from a political and leadership point of view. So, so thanks, guys. Again, great questions. Love them all. Great interaction. Have a great day today. Again, thank you for joining me. If we do have questions, please don't hesitate to reach out and have a look for the recording. It will come out over the next, week or so. In the meantime, like I said, all the best. Enjoy Q1, and we'll catch you on the flip side in Q2. Talk to you guys soon. Take care.